Well, good afternoon, everybody, and welcome to the September 29th edition of Bull Sessions. This one is dedicated to you and your questions via the Mailbag series. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here this afternoon by my two-guy buddy, good friend, Ken Kavula. Say hello, Ken.
Hello, glad to be here.
And the pictures across the bottom are just some fun. I mean, I found that wild bull stamp or postcard. Couldn't figure out which one it was. Just thought it was kind of cool. In that middle waterfall, you should recognize that one, Ken.
That's Tequamanon, isn't it?
Yep, Tequamanon Falls in the Upper Peninsula of Michigan. And for those of you that are not familiar with the northern half of the Lower Peninsula and the Upper Peninsula of Michigan, there's some spectacular scenery this time of year. In fact, some of our family members are headed that way this weekend just to take in some of that splendor. So, and Ken and Natalie usually drive around this time of year, right?
Well, we're hoping to carve out a couple of days next week and do a drive up into the UP and find a couple of nice, small, clean hotels to stay at and keep ourselves free of the virus, but just get out of our house for a couple of days. That's all. So
yeah, certainly know the feeling.
Yeah.
Right. So again, just as a reminder, this session is dedicated to questions and answers that we have received. We're going to throw a couple on the fire, and we'll probably have plenty of time. Our main motivation for today's program is to keep it brief, keep it informing and powerful, but keep it brief because we do have a roundtable tonight. So let's go ahead and get underway. Everybody knows the drill. We'll be talking about real stocks in real time, and therefore no investment recommendation is intended. This is about education and the sharing of ideas. Everything we do is for illustrative purposes only. We're going to talk about a little bit of philosophy tonight at the roundtable, but it really has to do with demonstrating the methodologies, philosophies, and practices of the modern investment club movement as promulgated by either NEIC, Better Investing, or Manifest Investing. All views are our own. We could own companies that we're talking about. We try to remember to disclose that when we do. Most of you, the people in this audience, a lot of familiar names, welcome back everybody, are familiar with the drill, but we do have, we sponsor and have a lot of fun with a monthly webcast. Tonight's September session is tonight. It is starting at 7 o'clock Eastern time to get out of the way of the presidential debate, which happens at our normally scheduled time. So we'll be getting out of the way. But the monthly roundtables, if you would like to be reminded, you can send an email to nkavula1@comcast.net, and Natalie will not inundate you with email, but she will remind you of stuff that you might want to know about. If you have a request about any of the information we exchange here today, including a copy of the slides, but most of you already know as Manifest subscribers, you have access to the slides in the Manifest forum. But that is my email address, markr@manifestinvesting.com. All right, Ken, are you having fun yet?
I'm having fun, Mark. Yep.
It's good stuff. I mean, the Bulls at the top, that's one of our favorite investment clubs. We started this a couple months ago, and we think it can be a meaningful way to be driven towards and discuss topics of interest to the audience. It's a chance to air out some stuff that we're working on. And again, it's the mailbag, what's on your mind, and we'll try to make it something of a tradition until you guys run out of questions. There's a number of topics on that list that we will be taking a look at. Doing a lot of stuff with renovating our fund, FUND data, and that is just generating all kinds of stuff. You've already seen some of the new companies that have been added to the database here in the last couple of weeks. But we're going to restrict the stuff to tonight or this afternoon to those highlighted stuff at the top. We want to talk a little bit about the condition of the market, the Buffett Stock Market Indicator, and just spend a few moments talking about and reminiscing about Cramer's book a few years ago called Get Rich Carefully. Any comments or questions, Ken? on that?
No, I think we're okay. I'm looking at this stamp here, Mark, and I see the profile of the Queen up in the corner. So I assume this is a Commonwealth country, but I don't know what it's come from Great Britain itself, or is this a Canadian stamp or an Australian stamp, or what is this
There's
exactly? Do you
a
know?
pretty good chance that it's Australian, based on what.
Australian?
Yeah,
No, it's English
it is English.
or British. Yeah. If it doesn't have the name of the country on it, it's British.
There we
Very
go.
humble.
That would be our Irishman sneaking in the side door
Yeah.
to enlighten us about all things British.
Yeah.
Good afternoon.
Also, P, pence. Australia uses dollars and cents.
Well, good afternoon, Hugh. How are you doing?
I'm doing well.
No coughing.
No.
All right. Well, let's tackle the first question. I think it's got an opportunity to talk about indications. I'd exchanged a few emails with more than one of you that was talking about the number of gurus, and there are a number of them, that basically are stirring panic and talking about the market being tragically overvalued and all kinds of stuff. So we thought we'd spend a few moments just talking about, what do we think about the market? Do we see that ugly bear on the left invading anytime soon, or what do the tea leaves tell us? And I'll start first, and you guys are both welcome to chime in. There's all kinds of Cape Shiller ratios and stuff that we could look at, all kinds of information. But one of my favorite ways to think about this question has to do with this long-term look at the value line arithmetic average that you see here. And this graph is no stranger to 90% of the people in the room. We're basically looking at a time series presentation on a quarter-by-quarter basis of the value line arithmetic average. That's the 1,700 companies in the value line standard edition, and basically their average price or their index constructed price in these green bars. The blue trend through all of that is just simply a mathematical regression. And the growth rate is something in the 8 to 10% range, and it's basically the slope of that line if you were to put it on log paper. But my answer to the question really comes back to, do I see this as being grossly overvalued? In order for that to be true for me, that green bar would have to be up here somewhere. Or, maybe a little bit less than that, but it would have to be above the blue line for that to be true for me. And any time that you see these white spaces and we sag beneath the blue line, those are usually periods of opportunity. As a long-term investor, first of all, and I'll be the first of the three of us to point this out, we really don't invest in markets. So we really don't care so much about the question. Maybe a little bit. It might provide some direction as to what we go shopping for, but we buy and assume ownership of world-class leading companies when they're on sale or when their stock price is attractive. And anytime you see this amount of white space that I'm showing over here on the right, it's saying that there are things that are attractive. You just have to go finding them. The higher that green bar gets, the closer it gets to penetrating and going above the blue line, the less obvious the opportunities are. So that's the way I think of it. Ken, your thoughts?
Well, Mark, you don't speak engineering very often to our audiences, and that's a good thing. But he did use the words mathematical regression, and that leads people to wonder where the heck that blue line came from. Mark didn't draw it. That's just a mathematical formula. There are a number of ways to do regressions, and that's just to kind of smooth out the data so you get a line or a curve that can approximate what's going on. And the computer drew this line, and it drew it using a pretty standard formula to calculate a particular mathematical regression. So don't go blaming Mark for the blue line. That's something the computer drew. And it's not the only regression that you could draw on this set of data, but it certainly is one of the most common ones that you could draw.
Hugh, any thoughts from the coast in California?
Yeah, sorry, a call just came in, so I had to get rid of it. I don't think the market's overvalued enough if it is overvalued, and for many of the same reasons that you said, but also the Fed has been pouring so much liquidity into the economy, it has to bubble up somewhere, you know? It's like walking across your lawn and it's all mushy because it's so wet.
Yeah, I would agree.
Mark,
So,
can either one of you come up with a time in history? I've been unable to. A time in history when we've had interest rates at this level for such a period of time, such a long period of time, and where they've kind of been guaranteed for a long period into the future. Can any of you think of a historical, you know, match to this particular period right now?
You're kind of adding
well, the only analogy that I would have, and this would be a scary one, would be Japan of 20 plus years ago.
That's exactly what I was thinking, Hugh. So ditto. Go ahead.
Yeah. So, and it's scary because the economy went into stagnation. And there are other factors in Japan. Demographics been a big driver that caused that. But I'm sure that experts at the Fed are very concerned about that. Honestly, it would be much better if they could have inflation. I use the term leak into the system here, but it would be healthy for the economy if the interest rates were higher, or at least if there was some indication of some kind of inflation. The only thing about inflation is it's like a controlled burn, if you want to use that analogy. If you tried it in California, all of a sudden you're going to have a wildfire that you can't get out.
Right.
I'm sure there's very concern about deliberately introducing too much liquidity into the system, you know?
Yeah, it's an interesting situation, but yeah, I would second that. Japan, and maybe there's some lessons or warning signals we should look out for there. And again, as Hugh said, I think some of the important characteristics and variables are sufficiently different that we won't have a situation like we had in Japan. The example I heard quoted fairly recently was that in Japan, back at the peak, the value of the emperor's palace was equal to all of the real estate in California.
Yeah.
I mean, that's I can't even get my brain around that for even a heartbeat.
Mm-hmm.
That just shows you how out of control things can get.
Plus, the other thing the Japanese were doing at that time is because they had so much money floating around there that they started to buy things overseas, particularly in the US. If you remember, there was a book that came out about 30 plus years ago called Trading Places that caused a bit of a kerfuffle because it suggested that the Japanese economy was on a path to overtake the US, and they were buying assets everywhere in the US and all over the US, even though the UK and even the Netherlands had bought more than Japan, but they were all concerned about Japan. But it turns out that Japan did its buying right at the peak of the real estate market, right before it went under in 1990 after the Cold War ended. So far, I don't think the US has been running around buying things overseas.
No, but there probably are a few attractive situations overseas too. And for that matter, Japan's been in the trough for so long that there were some recent mentions of investors, significant investors, like names ending in Buffett, having an interest in Japan. All right, here's
Mark. Let me extend that conversation and maybe put it into a topic to add to our list. I'd be interested in trying to explore industries that have a lot of candidates that are going to reside in that white space that we've constantly been talking about, and that are going to help us move that line above the trend. I'll give you an example of an industry that I think might be in that place because of a couple things happening in the U.S., and that's the retail housing market right now, and perhaps going for the next 2 or 3 or 4 years. I think that it's hit a demographic sweet spot. The biggest generation alive right now is not the baby boomer generation. It's the generation that's just turning 28, 29, 30. That's the cohort that is controlling the largest hunk of the population. And that's also the cohort that is forming households, having children, doing some of the things that that play right into, you know, buying a first house or moving into a house that will have enough room for a couple of children or something along those lines. So I'd like to maybe try to identify some places that are going to fill this white space and are going to fill it more robustly than some of the other kinds of industries we might be looking at.
That's a good mission. We'll add it to the list of things to think about and how we might go looking for that. And maybe we'll piggyback on Jim Cramer again and see if he can come through with another COVID index. All right, switching gears a little bit to another indicator of the total stock market. We do at Manifest Investing like to refer to all of the above investing. That's because it is the value line arithmetic average. It's, again, 1,700 companies in the standard edition. And what that means by definition is that there's 500 very large companies in there that represent the S&P 500, but there's another 1,200 companies representing medium and small-sized companies. So that's where we basically believe that, in addition to the fact that this is equally weighted, so all 1,700 companies get the same number of votes as Apple in the performance of this line. And what we're looking at here is 20 years on stock charts of the value line arithmetic index. And you can see, obviously, it's not a straight line from left to right, but it's going in the right general direction. Again, even as we look to the right-hand side of this, there's the February and March excursion with the beginning of the pandemic. But I would make the argument that general trend or general tendency is not dramatically high with respect to the long-term trend. What I see happening is that basically we're back where we were almost 20 months ago, after gaining a substantial amount in this recovery. And it's certainly looking mighty V-shaped to me. But using this as an indicator, again, I do not see tremendous signs of overvalued. And let's take a moment and talk about the graph up at the top. That's a relative strength index. That's what RSI stands for. It's simply a mathematical calculation that is focusing in on price momentum, if you want to think of it that way. And one of the things that we talked about last summer with respect to this index, when you're talking about a mutual fund or an exchange traded fund, or for that matter, a larger portfolio of stocks or an industry group, the conventional definition of being overvalued, according to the talking heads or the rhinos or the Wall Street analysts, is anytime when that RSI goes above 70. And that's why you see the 70 with a solid line on here. Technically, it's overvalued, and it's become very popular, a lot of momentum. But again, for a large group of stocks, like the value line 1,700, that moment really only happens when you get up to 80. And that's what I've drawn this dotted line in for. And over the past 20 years, we've actually only had 3 moments when it hit a relative strength index of 80 on this, looking at it from this very long-term perspective. Keep in mind that this is a monthly look, not a daily look. Monthly look because we're long-term investors. But there have been 3 moments in time where you could actually make the statement during these points in time, here and then back in this time frame here, and then again about 2.5 years ago, that you would not be surprised by a stall in the market, almost like an airplane stalling in mid-flight. And all 3 of those did come to pass. So if I saw this same type of formation as you see right here, in the current day situation, I would answer the question, yeah. But I wouldn't call it overvalued at this point. Does that make sense, Ken, the way I just explained that?
Absolutely, Mark. Mark, we have a couple hands in the air that would like to say something. So, Nick, I'm going to unmute you first. Go ahead, Nick.
Yes, thank you. Going back to Japan about 20 years ago, I just want to add something here that I read a couple of articles, I think in the Wall Street Journal, saying that the debt to GDP was now over 100%. And the last time that happened was in 1946, and it took the United States about 20 years to get the debt down. I'd like to know what the debt to GDP was in Japan 20 years ago. Was it over 100%?
No, it was much smaller than that. It's over 200% today.
Oh,
But I think Japan at the time had, but I need to go back and check, and I'm talking about 1990, the time that Trading Places book came out. I think Japan was given as an example of a country that had very, very low debt right before it went into its stagnation.
right. Well, I know that Mark has come up with his own chart for debt to GDP, and maybe this might be a suggestion for him to revisit that to see where we currently stand.
Well, I know we're at about 120% now in the most recent version of that chart.
Okay. Okay. I didn't know if that would be a subject that might color the current situation.
Yeah, and maybe we look at it in terms of a Buffett indicator we're going to talk about in a few minutes with respect to Japan, focused on Japan. That might
Our other hand, Mark, oh, I'm sorry, go on, finish up, Mark.
Well, go ahead.
Our other hand was from Howard, and Howard, I'm unmuting you. Howard, I can't unmute you because you're muted on your end. So if you'll unmute yourself, you should be able to speak, Howard.
Yeah, I was just, the term stagnation is what you described the Japanese 20-year period as, but really they were fighting deflation. And I think that that's what the Federal Reserve is currently doing. That's why, in spite of all the liquidity that's been added to the system, interest rates are at record lows, especially mortgages. And that accounts for the, the housing activity. I think about a week ago, mortgage rates for 30-year fixed rates hit the lowest in its history.
Yes.
So there's a lot of stimulation going on for fear of deflation. And I think what's happening is that the lower half of the economy in terms of labor force is they're suffering dramatically. And the sad part is that, as everybody knows, all the asset appreciation is going into fewer and fewer hands. Yeah. So there's probably a genuine deflation underway that the Fed is trying to fend off. That's about it.
Yeah, that's a great point about the deflation for sure. And then that
deflation is
yeah. And
Nick wanted to say some more, Mark, so I'm going to unmute him again, okay?
Thanks.
Go on, Nick, continue.
No, I said everything I had to say. Thank you very much.
Okay, great. Thank you. Bye-bye.
All right, let's flip to the next one. Here's another look. This one is one of my favorites, just to kind of as a second opinion. It's from Morningstar. The link to actually find this at any point in time is right at the bottom. Anybody can go to it. And again, what we see left to right is the fluctuations in the market, including the back up the truck moment that we now recognize from late 2008, early 2009, and then pretty much a back up the truck moment in March and April of this year. It didn't last long. In fact, I can point to where I tried to make a hot dog in the middle of that graph and came back and couldn't buy what I was working on before I went to make the hot dog, but that's a story for another day. But no, the market is not dramatically overpriced compared to on the basis of the price to fair value ratio on the universe of stocks covered at Morningstar. So I don't see anything dramatic about that at all.
I think one of the things is that there are a couple of companies that are very aggressively priced. You can think of Tesla, maybe Netflix, perhaps Amazon. They kind of skew the trend to some extent, the indicators.
Mm-hmm.
Tesla particularly, it's crazy how valuable that company.
Absolutely. Any thoughts on this, Ken?
Well, I was just surprised to hear last week, Friday, one of the analysts on one of the closing bell programs at the end of the Friday's close make a prediction that this week, this very 5 days, where we have 4 days left now, 3.5 days left, but the market was in for a terrible, terrible swoon. And he was very specific, and they gave him all kinds of airtime. I'm just not sure that kind of commentary is beneficial to anybody. And yet, I think that's maybe what stokes a lot of these questions that you're getting. We're hearing a lot of people, I think, trying to position themselves so if something does happen, they'll be able to advertise that they called it. And I think that's a really counterproductive way for us to discuss the market or stocks or anything having to do with investing.
Yeah, it makes me want to get up in the morning and send out 2 emails every morning. The stock market's going to go up today and the stock market's going to go down today. And then I can go back and delete the ones that were wrong. No, okay.
Well, no, I know what you're saying, and I really believe there's a lot of our analyst friends are playing some of those games to get their face on TV more.
All right, Ken, I'll let you take this one away. This is one of your favorite indicators to judge us whether or not the place is overvalued or not.
Well, this is my par versus the Wilshire 5000, and I think that, well, I don't know. What are you going to say? I like my par very much. It gives an average number going forward for the entire database that Manifest Investing follows. That database, varies by as much as 20 or 30 or 40 stocks in various seasons. It goes up and it goes down. But the average has remained somewhere between 8 and 10% long term. And I think that's probably where the average should be. That's pretty well matching the average as measured by any other index that we follow. And what I like about my par is that I can see the movement week to week, month to month, quarter to quarter, and it does tend to move. You can see 3 quarters ago that bar, maybe you can point it out, Mark, that bar was up in the mid-teens. I mean, there's the opportunity. Didn't last very long, Mark was right, but that bar has since dropped down to 8 or 9, or sometimes it goes as high as 10 on a daily basis. You can watch it. If you don't want to watch it daily, watch it weekly or monthly or whenever. It's one of the few places that I can get a read on what the average stock in the market should be giving back to me. Now, I can get one from Value Line too, but I have to do a little bit of arithmetic to make that one kind of work out, and that's a heavy lift for some people in our audience.
Mm-hmm.
So,
yeah, and looking at the summary at the bottom, what you're looking at here is kind of a smorgasbord, or Parade's opinions on Parade. Here is the median for the Wilshire 5000. Again, you're talking 9%. That's not dramatically out of line in any way. I mean, it's certainly not almost 20, and it's certainly not 4, down at these lower levels. So yeah, it's somewhere more towards the normal. The projected return on value appears to be in a fairly normal range. This one really gets me here. The market's closer to undervalued than overvalued according to general price activity. And that's also true as far as that position in the 52-week range between the low and the target price. Again, fairly normal number here, as Ken was just mentioning, on the value line, low total return. And these are certainly very normal, and they're very close to each other. They're as close as I've seen them in a long time. A lot of times the analyst consensus estimate will run a little bit more optimistic than Morningstar with a lower price to fair value ratio. This one's pretty cool because this one is continuously updated at Manifest now also. But the other one that really kind of jumps off the page at me, this is the 1-year analyst consensus estimate of the upside for stock prices in general. And that 31 is anything but overvalued. So just some stuff that we look at to get a different feeling for where the market is at. And again, one of the other things that we counsel, it's a little bit radical, but I think we can all live with it. I still contend that if you're cashing a paycheck, and for that matter, most of us that are cashing some form of a pension or a retirement annuity stream or whatever, this stuff really does not mean that much. Now, but the exception I would make would be if you're a person approaching near the end of your life expectancy, or you're really doing some serious capital preservation for some reason, then yeah, maybe some of that type of stuff of shifting to very high quality stocks or shifting into cash equivalents can make sense when we get into one of these moments where the average return forecast appears to have bottomed out, or in the preceding a couple slides ago. Yeah, anytime you get one of these red arrows, this type of thing can happen, and it can be painful for a number of months. So again, if you're a person that is not receiving a continuous annuity stream or income stream, and you're near the end of life expectancy or whatever, it could be a time to take some action. But that's about all I have to say about that. Any closing comments on this question? Kind of a review of market indicators.
Well, only to say, Mark, that a lot of these projections are just that. They're projections and they're works in progress. And we've seen ups and downs on that screen where you showed the white space that indicated a recession. And we will continue to see that until the data is actually logged as past and it becomes fact. And as long as they're projections, we're going to see movement in both directions.
Yep. All right, let's go on to the next question. I actually got this from a number of people. Wanted us to talk about the Warren Buffett Stock Market Indicator, and they actually may be driving some of the stuff. Ken is a CNBC addict. He's probably well versed on this indicator. They spent some time on it there. But that is, I believe, a CNBC article, and you can see the headline. Anytime that they put a fairly sensational headline out there with it looks like Mr. Buffett has stuck his hand on a hot stove or something there. I also want you to notice the date. It is from the end of August, so things have changed a little bit since the end of August, but that article is out there. Let's go ahead and define it. And this actually ties in with some of the stuff we were just talking about with Japan, only in this case what they're doing is not just looking at total spending to GDP. What Buffett has used for a long time is taking a look at the market cap, in this case the Wilshire 5000 market cap, divided by the gross domestic product in dollars, and looking at it on a historical basis, going back to 1971 in this case. And the definition is there on the lower left, so you can see the definition. And this is what I was suggesting a few minutes ago. It might be interesting to look at the Nikkei Japan and see what it looks like. And then this article actually came with, or it may have been a companion article, an interpretation, which I have a little bit of trouble with. I got to tell you, I start to break out in hives and hyperventilate if I'm going to argue a little bit or debate Mr. Buffett. But by the strictest sense of that definition, we haven't been safe to invest since 2013 when we crossed over here. And we're in a really dangerous spot now. So my interpretation is, I don't know. But that is the definition of the indicator, and that probably is the gasoline for some of the people that you're seeing on TV, Ken.
Well, the only comment that I would have, Mark, and I've thought this for a large number of years, maybe as much as since the last Great Recession in 2008-9, and I'm wondering if some of the metrics that we're using by definition and the way they're collected have not kept pace with society. I mean, I know things are moving extremely quickly, I know that people are changing habits in ways that I never anticipated them changing habits as quickly as it's been done. And I'm wondering if our data collection keeps track with what's going on, and whether or not we're really measuring what we think we're measuring when we collect some of these numbers and then put them out to the public. Gross domestic product has always been a number that I thought was kind of squishy to begin with, and in a service-oriented economy, how accurate are our figures about collecting the gross domestic product of intellectual content? I'm just not sure we can count it like we can count cars and steel beams and copper pipe and that kind of stuff. So I don't want to say I don't agree with what he's talking about. I don't want to say that it certainly is takes you kind of aback a little bit to look at what's happening and to look at his danger zones. But at the same time, I want to make sure we're comparing apples to apples and all the way along this particular curve. I know that 1971 was a completely different time than 2020 because I lived and worked in both years. And I can't believe the changes that have been made in my 50 odd years of living and working. So,
I guess I would also throw it back to Hugh. What's your opinion on what 4 years at a 0% inflationary rate? What's it do to that chart? I mean,
well, there's that. That's another issue. Yeah, obviously stock prices will go up as alternate investment opportunities don't give a return. To push people into the market, prices will go up. But the other thing too about this chart is, certainly the stock price should reflect the value of the company in some way, and the value of all companies therefore should correlate somehow with the GDP, maybe not perfectly. But the big question is, what percent of companies are public today compared to, say, 20 years ago? There's that.
sure.
The other thing, because that'll look higher if fewer companies public.
Excellent point. Yeah.
Right. So the second thing is that the economy is going through a bit of a sea change right now, and you can see that in the valuation of companies like Amazon and Tesla. And as I kind of suggested before, many of the indices are kind of warped a little bit by the high valuation of these companies. I view the stock market as an argument on what the value of a company is, and that argument is settled in terms of price. And the person who shouts the loudest, offers the most money, the biggest price, wins that argument constantly. And right now, when the future is uncertain, it's anyone's guess as to whether or not there will be electric cars in 5 years or 2 years or 10 or whatever the number is, and self-driving cars. There will be a big change coming, and that's reflected in maybe an exaggerated price today. For sake, I'm picking on Tesla here, but there are many other companies that have been valued, some pharma companies as well, somewhat grotesquely.
Yeah, and we don't even have to look any further than Apple, which used to have a PE of 10 to 12 and now is at 20. And you pointed out the medical device thing that we'll be spending more time with in the near future. Yeah, it's things change, and I think there's a lot of variables in this graph that probably need to be considered very carefully in the formation of it and the utility of it as anything. All right, let's go ahead and close up with this moment. What were your favorite moments from Jim Cramer's Get Rich Carefully? The link that you see there is our blog for Manifest Investing. It's free, so you can go to that, and it's actually from 2015. Ken and I and Nick Strategos and Eve Lewis, the former chairperson of she still is chairperson of the National Association of Investors, Better Investing, got together to do a book review. And my nutshell reaction to it was, when I was invited to do it, I was skeptical, and that's kind of sugar-coated. but I was pleasantly surprised by the text that I read, and in fact, read very carefully and thoroughly enjoyed it. Is that the way you remember it, Ken?
Well, yeah, and the two things that I took away from that whole exercise, Mark, and I did read the whole book, and there were a couple chapters that I reread, but first of all, I was struck by how well many of the chapters stood all by themselves. That you didn't need some of the other chapters. You could focus in on some of his ideas, and he presented them in a pretty standalone fashion. But the biggest idea was that I kept coming across one of the things that I have believed since the very beginning, since first joining an investment club and first becoming involved with Better Investing, and then later Manifest Investing. And that's the idea that if you're really going to become an investor, you have to do some homework. And he's a great believer in homework, and he keeps telling people that sometimes it felt like every 3 pages he was reminding you that you had to do your homework. I think that's a valuable lesson for all of us that are investors today, that you can't just pick a name and ride it to the top without knowing a little bit about it, without coming up with some ideas about when you might want to sell it and when you might want to add to it, all the rest of the stuff that goes into managing a portfolio. So I kind of thought when I was made the assignment that this was a clown, and he was a popular clown. But as I read what he had to say, and as I listened and thought about what he had to say, I realized that you had to separate the entertainer from the thoughtful investor. And he indeed is a thoughtful investor. Maybe a little bit hard to take when you listen to him in person, but he's a thoughtful investor.
Well, I'll share one of my moments, and there are a couple major ones. I'll take another turn here in a minute after you go again, Ken. But this notion of taking the fear out of the daily trauma of the markets, and when you are behaving as an investor, especially amongst a group of investors, there's a lot of things you can avoid. Those pitfalls of rash judgments and judgments with little or no information. And, we basically have some techniques that avoid as many landmines as possible. You don't have to miss them all. Every once in a while, you're going to get one. That's the rule of 5. But you can do this kind of stuff. You can invest in companies. Don't have to invest in markets if you don't want to. You can invest in individual excellent companies. But the one moment that really has made an incredible difference in some of the portfolios that I've been involved with, including my father's. He's one of those individuals that was a little bit closer to the end of his life expectancy here over the last several years. And one of the things that Cramer pointed out in the book is that recessions don't happen while people are employed. So you can look at all those indicators we were talking about a few minutes ago with respect to peaks in the market and people prognosticating about recessions. And Cramer pointed out that the green area, that's basically the employment, the non-farm payrolls, and that's been on a pretty good run since the 2008-2009 market test until here fairly recently, and that's going to prove to be what I believe will be a fairly special moment. Hopefully COVID will behave itself this fall, or vaccines will fall into place, and good things will happen. But the thing I want to share is that, during that 13, 14, 15, 17, 18 time frame, there were a number of times when people were out there talking about running for the hills. And I would basically look at this graph, sit down with Dad and say, Dad, yeah, maybe we can switch to some higher quality companies, but I don't see a need to run for the hills. And that over that time frame, that big upward slope in that green bar, because this again is an overpowering factor when it comes to the damage done by recessions. And I just think that was such a valuable moment. And I can point to many, many thousands of dollars of difference that it made in portfolios where we didn't get too protective or too precautionary, leaning on the backs of this one piece of advice. And again, we don't overweight and use just one piece for anything, but this is a very compelling piece of information. What are your thoughts on that, Ken?
Well, I've the paragraph in italics, we are now ready to triumph, etc., down there at the bottom. That's basically what we've been talking about on almost every program that we've ever done together, Mark, and that's have some patience, have some discipline. And if you have those two ideas together with a little bit of understanding of the market, the willingness to share your ideas with like-minded people, you have a nice recipe for success.
Yeah, and one other moment that I will share from the book, I don't have it in my hands. I meant to do that before the session, but there's a section in there where he talks about the dark pools and the high frequency trading, and a lot of the, I'll just call it, throw it in the bag of nonsense that was going on approximately 10 years ago, and some before. But he just gives the most wonderful long-term perspective as to, kind of shrug that stuff off. Does it really matter? Does the fact that they're using nanosecond trading on your Procter & Gamble, doesn't really matter if you're holding a company like Procter & Gamble or Lilly or Abbott or Merck or McDonald's, and you're holding it for a very long time. That stuff doesn't matter. It really doesn't. And it doesn't do any long-term damage of any significance or consequence to us as long-term investors. And he covers that very well in the book. All right, just a quick reminder that if you're watching this on YouTube, please subscribe if you'd like to get reminders, and please like it if you hear stuff that we talk about. Encourage us to cover the things that mean the most to you, all of you. So if you go to YouTube and just search Manifest Investing, you'll find this page. We would greatly appreciate it if you would go ahead and click that subscribe button. And last but not least, I'll let Ken let the cat out of the bag just a little bit more.
And I'm not sure what you're talking about our Successful Investing 2 conference on November 11th and 12th. We are going to be running a free conference, very similar to our conference that we ran back last May. We're going to have 5 classes, including a stock panel where we'll give you great ideas for stocks. We've put together quite a distinguished panel of investors, people that are fun to be with and people that will come up with some great ideas for you. And right now, we're just going to ask you to save the dates, November 11th, 12th, and 13th. And all of these things will happen in the mid to late afternoon. We're not going to try to tie up your evenings. We're going to run things from approximately 1 o'clock in the afternoon to approximately 4 o'clock in the afternoon. That's Eastern time. And again, November 11th, 12th, and 13th. Right now, just save the date, and I can guarantee you that within the next 2 weeks or so, you'll start to get material. If your name is on that reminder list for the roundtable, then you will get material for us. If you're a Manifest Investing subscriber, all that material will also be on the Manifest Investing website, and it'll also be on the Mid-Michigan website, on the Better Investing website.
And I also wanted to point out that we, obviously for those of you that have day jobs and you're listening to this, we do save the sessions at YouTube, and you can actually access, in fact, the entire May program is available as one playlist at YouTube. So you can go ahead and check that out. And I'll give you one tease moment here. You can go back and listen to that May program, and all of our stock panel selections are actually doing quite well. But the one that really grabbed me, and you talk about coulda, woulda, shoulda time, Pat Donnelly. He presented a company called Stone Co. And I would invite you to go back and look at ticker symbol STNE And look where it was in the middle of May and where it is now. That's your tease. Because I'm sure that Hugh McManus and Pat Donnelly, not just that they're Irish, but they're among a group of people that come up with some fairly interesting ideas to pursue. And with that, I think we can shut down the recording. I think that's all we have for today, but we can stick around for a few minutes if anybody's got any questions. Thanks, everybody, and good hunting. Keep sending us your ideas for best small companies. We're loving it, and it makes a difference. Thank you, everybody.